In this session, we will focus on free cash flow based valuation, which is also another category of discounted cash flow based valuation models. Earlier, we have understood that under this discounted cash flow based valuation models, we can use either dividends or free cash flows or even residual income as the definition of cash flows. So right now we will look at how can I use free cash flows from the perspective of valuing a particular equity security. So whenever we are talking about free cash flows, we have two different terms: free cash flow to the firm and free cash flow to the equity. So freely, how much cash is flowing to the firm, or freely how much cash is available to the equity investors. This is what is the definition of these two aspects. So just to look at slightly more detail about it, when I talk about the free cash flow to the firm, it is the cash that is available with the firm which can be used to distribute to all its investors. When I say all its investors, it includes the debt investors who have lent to the company as well as equity investors. After all the business related spending and payments, after the company has really spent and paid to the suppliers, vendors, everything, even for the capital expenditure for that year, whatever the spendings have happened, after that, whatever the cash that is left with the company, if possible, which can be distributed both to the lenders as well as equity investors, is what we are calling as the free cash flow to the firm. And out of that, if I am even removing whatever that needs to be paid to the lenders, like the interest payments as well as principal repayments, out of whatever the cash that is available post its operational and capital expenditures, whatever the amount that is, whatever the real cash that is left with the firm, we call it as free cash flow to the firm. And out of that free cash flow, whatever is the payment that needs to be done towards the lenders, which includes interest payments as well as principal payments or new principal raised, whatever it is, that portion if I take off, that is what we are calling as free cash flow to the equity. I mean that amount of cash is available with the firm to be distributed to the equity investors, because equity investors just get the residual, whatever is left after distributing to the lenders, whatever is left, that is what is going to the equity investors. So when I say free cash flow to the equity, it is that amount of capital after that amount of cash after the company has really spent everything for the business in that year and also made the necessary payments that need to be done towards the interest and the principal payments. Whatever is the cash that is really left, that is what we are calling as the free cash flow to the equity. So when I project, now when it comes to valuation, I am projecting the free cash flow to the firm as well as free cash flow to the equity for the next few years. Any valuation process, the present value of the future cash flows. Here instead of cash flows, we are taking them as the element which we are considering as cash flows here is free cash flows. So that free cash flows I have to project for the future. It could be for an infinite period because we generally assume that the firm is a going concern. So I project the free cash flows for the future. So it could be FCFF or FCFE, any of them. I am projecting them for the infinite period, discounting them to the present value. So what I am using for discounting, if I am projecting FCFEs, then I will discount them with the real required rate of return of equity. If I am projecting FCFFs, I will discount them with weighted average cost of capital, because this is the return that is expected only by equity investors. But when I say weighted average cost of capital, it is the return that is expected both by debt investors as well as equity investors. So I discount FCFFs by the weighted average cost of capital to arrive at the value of the firm in total, wherein you have debt as well as equity separately. So the FCFF model will give me the total value of the firm, not the value of a share, right? So out of that total value of the firm, I remove the value of the debt, which is nothing but the amount of debt principal that is outstanding as of that particular date. If I remove that value of debt, whatever I am left with is the value of equity. So it does not give me the value of equity share directly. I will end up finding out the value of the firm by discounting the future FCFFs by the weighted average cost of capital, and from that I remove the value of the debt, which is the amount of debt that is outstanding as on that date of valuation, which gives me value of equity, and then divide it by the number of outstanding shares to arrive at value per share. So especially it is very good to have, if the company is having very huge volumes of debt also, or the capital structure of the firm, capital structure is more or less volatile, it's not constant. If the capital structure keeps changing year over year in all these, and if that too the debt composition is significantly higher, it is better to use FCFF based model rather than FCFE based model, because there is a possibility that if the company is having heavy debt, after the operations, if I take out the payments towards the interest as well as principal repayment to arrive at FCFE, it may so happen that the FCFE may turn negative, whereas FCFF is positive, especially for a firm which has very heavy volumes of debt. So from that perspective, negative FCFEs may not have any kind of an influence in the valuation process. So it's always better in those kind of situations we resort to FCFF based valuation, identify the value of the total firm, then subtract the value of the debt to arrive at the value of equity. So even FCFF can help me finding out the value of the firm, but may not be a direct route. I start with valuing the firm first, and from there subtract the debt to get the equity part. Whereas when I am talking about FCFE, I discount it with the required rate of return on equity. I don't consider the debt at all. So only when the capital structure is more or less constant, means debt is existing but the proportion is more or less the same every period, whenever I have such kind of scenario, it's better to use FCFE based models. And few more important points to remember in this context. Any corporate action that the company gets into, especially declaration of the dividend or share repurchases, any such kind of corporate action, it does not have any kind of change on FCFE or FCFF, because we are defining FCFE as the cash that is available with the firm. The cash that is available with the firm after the operational and the capital expenditures, right? The dividend is a part of whatever the cash that is left. So out of the cash that is left, the company can think of paying some portion of it as a dividend, or it may not pay any dividend. So, but what we are trying to compute at the layer of FCFF or FCFE is one layer above the dividend itself. How much cash is really available with the firm? Whether it pays a dividend or not, it is as per its dividend policy. We are not even coming to that step. We are simply looking at what is the cash that is available. Let it do whatever, let it retain, let it pay dividend, let it do a share repurchase, whatever it wants to do, let it do. We are looking at FCFE and FCFF one step above that process itself. So any such kind of corporate actions will not have any impact on FCFE or FCFF. And similarly, any change in the capital structure, leverage increasing, decreasing, it may not impact the FCFF at all. To some extent, it will impact FCFE, because in FCFE we are talking about subtracting the payments towards the debt investors in terms of interest payments as well as principal payment. So with a change in the capital structure or change in leverage, I see FCFE will get impacted, but FCFF will not. But coming to the corporate actions, anything, any dividend, share repurchase, whatever is happening, we are focusing one level above it. So these things will not impact the FCFE or FCFF at all. This is one important, interesting aspect that we need to be comfortable with, right? And so if at all my objective is to arrive at the value of the firm, the focus is using FCFF. Value of equity, I can use either of the approaches, but if at all my capital structure is constant, it's better to go and try with the FCFE based approach itself. Alright. See, when do I need to go with the free cash flow based approach? See, we have a dividend based discounting model approach. We also have a free cash flow based valuation approach. When should I look at it? To some extent we have discussed on it, especially if the company does not pay any dividend, or whatever the dividend that is paying is not in line with the earnings, when it is not in line with the long-term profitability of the company. If the dividends are in line with the earnings of the firm, where the firms are majorly declaring constant kind of dividends or constant growth in dividends, which are more or less aligned with the earnings which they are having, and it is in line with the long-term growth rate of the company, then looking at dividend discounting model is appropriate. But most of the times we find firms don't fall into any of these categories. So which means even though a dividend discounting model is available, it's always suggested that we can look at a free cash flow based approach, because most of the times we find firms, they don't pay either dividends in a regular manner, or even if they pay the dividends regularly, it may not be in line with the earnings, and it is at the discretion of the management, which may keep changing altogether. So there is an intervention at that time, management intervention. But whereas when it comes to free cash flow, I am really not bothered about the dividend policy of the company itself. They may pay dividend, they may not pay dividend, they may pay poor dividend, they may pay completely unexpected kind of dividend. We are completely not bothered, because we are operating at one step higher. And the other dimension to look at is, especially when I am trying to do the valuation of the firm from a controlling stakeholders perspective, especially if the objective is for acquisition or taking a private equity kind of a stake in that particular firm, wherever the intention is from a majority or a controlling stakeholder's perspective, it's not advisable to look at a dividend discounting model at all, because the dividend discounting model is purely based on dividend, which is generally set by the majority stakeholders itself, which is set by the controlling stakeholder itself. So probably if I am evaluating it one level above, I can very well think of this particular controlling stakeholder having the flexibility to alter the dividend payment policy also. So from that standpoint, it is always advantageous to look at a free cash flow based valuation compared to a dividend discount. It's a straightforward universal truth. Using a free cash flow based valuation is always better than a dividend discount valuation, but computing the free cash flow is difficult, whereas a dividend is readily available. Dividend is an entry that you find in the financial statement, but free cash flow is an entry that you don't find. You have to end up computing the free cash flow. So except for the computation process, rest all in all other aspects, I see the free cash flow based valuation model is more effective compared to the dividend based model, because one more advantage is the value recognition is immediate. Means irrespective of whether the dividend policy is in line with the long term profitability objective of the company or not, we can really rely on the value that is generated by the free cash flow based model. But when it comes to dividend based, only when the dividends are in line with the long term profitability of the firm, then only I can look at using the dividend based discounting model. So even from that standpoint, it's advised to go with the free cash flow based valuation model, which means it is worth understanding how we compute the free cash flows from given the income statements and the balance sheet. How do we end up computing the free cash flow so that we can do the valuation much better compared to a dividend discount kind of a model. So in the next stage, I'm going to focus more on how do we compute the free cash flow given the income statement as well as the balance sheet. There are multiple ways of looking at the free cash flow. So going with a simple definition, free cash flow is nothing but the cash flow from operations, whatever your operations has generated as the cash flow, I add back the interest to it. Why do I add back the interest? I'm looking at the cash flow to the firm. And when I'm looking at the computation of CFO, computation of cash flow from operations, it did not add up the interest. So in the typical computation of cash flow from operations, if I go with an assumption that I'll take net income plus non-cash expenses minus change in working capital, then for computation of free cash flow to the firm, I have to add I into 1 minus T. This is one important aspect. Now, when I say cash flow from operations is this, there I am treating interest as going into cash flow from operations. This is as per US GAAP. But when I am looking at IFRS, the interest paid can go either a part of cash flow from operations or cash flow from financing. If I take it as a part of cash flow from financing, then probably my cash flow from operations itself would have added I into 1 minus T plus non-cash expenses minus capex. So the example which I am giving here is under the assumption that I am following either US GAAP where the interest paid is being treated as a part of cash flow from operations, or even though I am following IFRS, in that I am treating the interest paid as a part of cash flow from operations and not cash flow from financing activity. So under that assumption, I can say the cash flow from operations is nothing but net income plus non-cash expenses, especially depreciations or amortizations, right, which all go as a part of the non-cash expenses, and even the deferred taxes. This also is, so all these things, whichever I am treating as non-cash expenses, they are added back, and I am subtracting the changes in working capital. This is what we are calling as cash flow from operation. This cash flow from operations, I add up interest into 1 minus T, and I subtract the capital expenditure for that year, which is nothing but change in fixed assets. Capital expenditure is nothing but change in gross fixed assets. That is what we call as capital expenditure. So if I am handling it at a net level, change in net fixed assets plus the depreciation for this period. That is what is the change in net fixed assets. You can work out on whether you are looking at gross fixed assets or net fixed assets. If it is gross fixed assets, you can directly take as change in gross fixed assets, no depreciation to be added. So that is what we are calling as a capital expenditure. So cash flow from operations, I add up interest into 1 minus T minus the capital expenditure to arrive at FCFF. And as I have already said, FCFF is the cash that is available to be paid to both the debt as well as equity investors. So out of this, I subtract what needs to be paid to the debt investors. I into 1 minus T has to be paid to the debt investors, and at the same time even the principal repayment. So principal repayment or additional principal taken, whatever it is, so that part also needs to be added. So that's where we use it as net borrowing. Otherwise it is like minus principal repayment plus new principal taken. This is what is the free cash flow that is available in this year to be paid to the equity investors. So we need to be comfortable in doing these calculations given the income statement as well as the balance sheet. I should be able to find out the cash flow from operations, which is generally done using the net income plus adding up the non-cash expenses, which majorly include depreciation, amortization, and the deferred taxes or any other provisions for restructuring activities, etc. And I also remove the changes in working capital. When I look at the working capital here, I look at the non-cash related stuff, basically accounts receivables, inventory, and accounts payable. So probably for year 1, I find out the accounts working capital as accounts receivables plus inventory minus accounts payable. Similarly for year 2, I can compute the same. So year 2's working capital minus year 1 working capital is what is the change in the working capital. So if it is positive, my cash is going down. If it is negative, my cash is going up, and vice versa. So whenever I am getting into the computation of FCFF, I am taking the cash flow from operations, adding up the interest into 1 minus T, subtracting the capital expenditure. So the cash flow from operations includes the net income, the non-cash minus the working capital. Sometimes, so in a simple way, if I have to write FCFF from the scratch, It is nothing but net income. CFO I am writing as net income. Non-cash expenses I am just taking depreciation as an input base, minus capital expenditure, minus changes in working capital, plus I into 1 minus T. This is what is the entire FCFF. Just substituting instead of CFO, I substitute this entire thing. So this is what is the value of FCFF that is coming. Now you can play around. If I include these two things together, this is nothing but EBIT into 1 minus T. You just need to have that comfort level in terms of clubbing the values. So this is coming out as EBIT into 1 minus T plus depreciation minus capital expenditure, everything else remaining the same. So that is one more way I can use this concept of FCFF. Given an EBIT, I can still find out what is my FCFF. The other way, probably along with these two, I even club this. Right, along with these two, I even club this. It becomes EBITDA into 1 minus T plus depreciation into 1 minus T. Sorry, depreciation into T. Because EBITDA I am considering only 1 minus. So from the depreciation only 1 minus T part is considered. So again I am bringing out the additional tax part of it. So these three put together, it becomes EBITDA into 1 minus T. So from there I subtract the capital expenditure and the changes in the working capital to arrive at FCFF. So if I am able to identify the FCFF at this level, net income plus depreciation minus changes in the working capital plus interest into 1 minus T minus capital expenditure. At this layer, if I am able to remember FCFF, I can play all kinds of combinations. And when it is coming to FCFE, I am subtracting I into 1 minus T here and I am adding up net borrowing. If it is a repayment, then probably it would be a subtraction. If it is a new borrowing, it is a kind of addition. So this may FCFE may result in this term getting striked off. So basically you can very well work out with the remaining aspects. So here now again this is nothing but cash flow from operations. Cash flow from operations minus capital expenditure plus net borrowing is what is the formula for free cash flow to the equity. You can really play around with all these formulas once you get an understanding of the base formula altogether. So compared to a dividend based model, the difficulty that exists with the free cash flow models is I require the financial statements for the future years, based on which for each of the years I end up computing the free cash flow to the firm as well as the free cash flow to the equity using these processes, and I need to be comfortable in computing those two aspects. After that, once those free cash flows are ready, in case of dividend discounting model they are always ready, whereas in case of free cash flow based model, let's say I have to compute those free cash flows for each of those years. After that, discounting them to the present value and all is the same process that we do with respect to the dividends itself. So the computation part you need to be comfortable with. If someone if you are presented with an income statement as well as the balance sheet, so you can take the net income, add back depreciation and any other non-cash expenses that are there, and add back the interest into 1 minus T. T is the effective tax rate, and you could also subtract the change in working capital. So from the balance sheet, look at the addition between the accounts receivables, inventory and accounts payables, right? Account receivable plus inventory minus accounts payable for each of the years, which will give me working capital. So the difference between the working capitals is what we subtract. Similarly, you can look at capital expenditure again from the balance sheet, the gross fixed assets. You subtract year 2's gross fixed asset minus year 1 gross fixed assets to arrive at capital expenditure, and that can be used to compute FCFE. And probably when we are talking about net borrowings, you look at the long-term debt of year 1 and long-term debt of year 2. The difference between these two is what will go as a part of the net borrowing for the period. You can use all these values to arrive at computing the FCFF as well as FCFE, which will go into the valuation process using the same set of models which we have discussed for this dividend based valuation also. The single stage model or 2-stage, 3-stage kind of various models they are typically deriving the value of the firm using the free cash flow approach, right? So let's get into the valuation aspect. Now that we know how do we compute the free cash flows, we can use these free cash flows as an input towards our valuation approach. Another aspect to look at in this case is look at this FCFE formula. Probably I am trying to bring out a slightly different version of FCFE. So when I take FCFF first, net income plus depreciation minus change in working capital plus interest into 1 minus T minus capital expenditure, that is FCFF. Then from here if I subtract I into 1 minus T plus add back the net borrowing, that is what is the FCFE. Now an interesting dimension is I club all these three elements. So I say net income minus capital expenditure plus change in working capital minus depreciation. If I make an assumption that whatever is this difference, that is the cost for this particular period, that is the additional capital for this period, if I assume that it is equally financed, it is financed in the same proportion using debt and equity as its typical debt ratio itself. So in that case I don't need to bother about this net borrowing. If I am assuming that this is the excess for this year, so if its debt equity ratio is 30% debt, 70% equity, I assume that this entire thing is financed in 30% debt and 70% equity, which means the 30% would have been the net borrowing altogether. That is the way if I am operating, then probably this entire number I can very well go ahead. If I am subtracting 30% as the additional borrowing, only the 70% of it will go into it. So that's where I will take 1 minus the debt ratio. Debt ratio is debt as a proportion of debt plus equity. So whenever I take this entire thing multiplied by 1 minus debt ratio, that is also another aspect of expressing the free cash flow to the firm. So each of the years I can find out the free cash flow to the firm as well as free cash flow to the equity through these various mechanisms and then use them for the valuation purposes. Now sometimes I see if at all people are not able to compute the free cash flows, they try to use some other elements of the financial statement where the elements are directly available. They are used as a proxies for free cash flows. Generally we see net income being used as a proxy for free cash flow to equity, and EBITDA is used as a proxy for free cash flow to the firm. Now, there is nothing much to explain for you, because we know the free cash flow to equity actually is net income plus depreciation minus change in working capital minus capital expenditure plus net borrowing. Now, how can I use NI as a proxy to FCFE when these things could be very much significant? So, if the borrowings are going to be significant, or capital expenditure is going to be significant, or working capital investment is going to be significant, it may so happen that net income will become a very poor proxy for FCFE. When you really assume that none of these is going to be significant, then we can think of using net income as a proxy, especially if I say no, this is not a capital intensive business at all, completely equity kind of a business, and working capital change is very, very nominal. When I assume all these things, and for any industry which works in such a kind of a model, probably I can use net income as a proxy to the free cash flow to equity. But any of these forming significant, this net income will form a very poor proxy to FCFE. Similarly, when I am looking at EBITDA as a proxy for FCFF, we have defined FCFF already in terms of EBITDA, right? FCFF goes as EBITDA into 1 minus T minus the changes in working capital and capital expenditure. So, if the capital expenditure is significantly different and working capital investments are significant, and it does not even consider the tax structure at all, so it may so happen that EBITDA also may not be an effective proxy for FCFF. So, we have to try to understand where the gap lies, and if possible try to address that gap so that the valuation can become more and more comfortable. So, it's not advised to use proxies for the original FCFE and FCFF, just that because they are available in the income statements directly, it's better to go with the computation of FCFF and FCFE. Otherwise, some kind of approximation in terms of what could be contributed by those various elements as a percentage of sales, or as a percentage of EBITDA, or as a percentage of net income. At least to some extent, if we have such kind of information, things would be slightly better off. All right. Now, the valuation part using FCFE and FCFF is very much similar to that of dividend discounting models itself. We have a single stage valuation model wherein we assume that right from the next period onwards, the free cash flows are assumed to grow at a constant rate forever, not every. So, the FCFE free cash flows are assumed to grow at a constant rate forever from the next period onwards. So, we can directly use, just like the way we have used D1 by R minus G as the value of the firm, here we will use FCFF1 by WACC minus G, because here the required rate of return we are taking as weighted average cost of capital, especially if I am looking at free cash flow to the firm. But if I am using free cash flow to the equity, then I can still use R minus G itself. So, these are the values of the firm, especially if I am assuming that the firm is going to grow at the constant rate from the current period onwards. It's exactly similar. But again, just like the way we are handling a dividend discount model, if I am assuming that the FCFF or FCFEs are going to grow at some higher rate for the next few years, because the firm is not a matured firm, it could be in the initial or transition kind of phases. So if I assume that for the first few years the FCFEs and FCFFs are going to grow at a slightly higher rate, followed by either a stable growth rate after few years, or followed by a gradual slowdown, and after that a constant growth rate. So just like the way we have discussed in case of dividend discounting, we can have 2-stage, 3-stage, H kind of models. But in all the models, the commonality is I discount each of the year's free cash flows to the present value using either the WACC, weighted average cost of capital, or the cost return on required rate of return on equity. I discount with either of them depending on whether I am using FCFFs or FCFEs. Find out the present value and associate it as the value of the firm or value of the equity. And of course, we know the way we compute the weighted average cost of capital is nothing but weightage of debt into cost of debt. Just as a quick revision, weighted average cost of capital is weightage of debt into cost of debt post tax plus weightage of equity into cost of equity. This will give me the weighted average cost of capital, and I can forecast the FCFFs and FCFEs for the next few periods, and based on that discount them to the present value using the appropriate growth rates. So that is how we compute, and everything is exactly on the same lines as the dividend discount models itself, except for one small change. Dividend is replaced by the free cash flow, and the required rate of return is replaced by weighted average cost of capital only if we are talking about FCFF. Otherwise it's same, the required rate of return itself if I am looking at FCFE kind of a model altogether, right? Now we'll take up one numerical to try to understand how do we compute the FCFF and FCFEs in each of the cases, and how do I get into the valuation process accordingly. Okay, so let's get into the numerical, right? Let me take the spreadsheet for this. Okay, so all we are trying out here is I'm looking at computing the FCFE and FCFF and then using it as a part of the valuation process. So we'll start off with the year 0, the current values. So probably let me call that as year 0, 1, 2, 3, 4, 5 and 5 plus after from the 6th year onwards. Okay, because we are having 2-stage kind of growth, 2 periods. Let's see what is happening, right? Okay, the current net income 146.2. so net income here I am taking it as 146.2. then capital expenditure for the current year, so I'll take capex for the current year is 5.82 million. Then I can take depreciation for this period is 9.27 million. Net profit margin is 12.8%. So net profit margin I'll take it as 12.8%. Right. So from here probably if I want net income, current net income, net profit margin. So from here actually I can compute, net income, or probably let me change this to the sales. Instead of taking current net income, probably I'll take it as current revenue. So let me call this as the revenue for the period. So from here I can get net income, which is net profit margin times the revenues. So almost this is working out to be my net income. Then working capital investment for the period is 20.5% of the revenues. 20.5% of the revenues. So the working capital investment for this period is coming to be this much. And all the above are expected to grow at 10% every year for the next 5 years. Okay, so this is expected to grow at 10% per year. So the revenues are expected to grow at 10% per year for the next 5 years. Capital expenditure, depreciation, these are expected to grow at that rate. Probably the net profit margin may not grow, which means still the net income may still grow at that rate. Right, but yeah, for the net profit margin I must still maintain it at this particular percentage itself, which means the net income can still grow at that particular rate. And the same way I can look at the working capital investment also. So for the next 5 years it is expected to grow at the rate of 10%. Then analyst one thinks that they all will fall to a stable 6% growth from the year 6 onwards. So from the year 6 onwards, all these are expected to grow at 6%. So I'll multiply each of these things with 6%. These three at least I'll multiply with the 6%. This net profit margin I'll still keep it. So which means this one I'll take it as multiplied by 6%. So from here I can very well say that this is the scenario as far as year 6 is concerned, or year 6 and later is concerned. So from here the analyst one is thinking that there is going to be a kind of infinite growth, constant growth for an infinite period. So from here now I can find out the free cash flow to the firm as well as free cash flow to the equity. Is there any other information? Yeah, tax rate is 35%. Analyst 2 thinks that they will come to 5% over a period of 4 years and then continue at 5% stable forever. So probably when I am looking at analyst 2 will complete for analyst 1, or probably let me take the scenario for analyst 2 directly. Until here there is no change for both of them, right? Until here there is no change for both of them. Only here probably all he is saying is they will come down to 5% over a period of 4 years. So from 10 if it has to come to 5, then probably each year there is a down of 1.25%. So it is coming out to 8.75, 7.5, 6.25 and then 5. So what I will do each of these years. So this, the previous years I will first increase by 8.75%. Right, this I will increase by 8.75%. Similarly here, this I will increase by 7.5%. Alright, this is as per the second analyst. and this I will increase by 6.025%, and the next one I will increase by 5%, and from here the expectation is there is a constant growth rate, right? All right. Now the next part for me is I need to compute the FCFF and FCFE in each of these cases. So what is that I am looking at? FCFF and FCFE, at least for this period. I am assuming, okay, I can compute the FCFF, or anything else is there? Yeah, something more is there. The common shares are 2 million. Outstanding debt is 152.6, out of which the interest is 10%. So probably the interest is one more aspect. Probably it's better that I do interest into 1 minus T directly. 35% is the tax rate. So I'll talk about interest into 1 minus T at this moment. What is the interest? 152.6 million is the loan. 152.6 into 10%. That is the current interest, and of course if I have to take it post tax, then I will take it at 65%. So this is what is the interest into 1 minus T, and it is expected to behave the same way as the above element. So probably just like the way I have done this, I am expecting I will do the same for the interest also. The same logic here also I will follow, right? Interest into 1 minus T, the same way I will continue for the first year, and from each of the years onwards I will take it in the same way that is expected by both the analysts. Okay, so now at least I should be ready in terms of computing the FCFF. Let me try. FCFF, cash flow from operations. So I'll start with net income. Okay, this is the net income plus depreciation, which is the non-cash kind of an expense, right, minus changes in the working capital. So this is the change in the working capital, so I am subtracting that. To this I am even adding up I into 1 minus T, and I am even subtracting the capital expenditure. So this is what is coming out as FCFF for this particular period. And probably I can drag this FCFF to each of the periods, which is finally coming out as, how come this working capital investment is looking so high? No, this is the working capital investment, which has to be this much times 1.06. okay, so this is what is coming out to be my free cash flow to the firm. And if at all I have to find out the free cash flow to the equity, from the free cash flow to the firm I subtract the interest into 1 minus T, and I add back the net borrowing. The net borrowing there is nothing else, so which is working out for the computation of the free cash flow to the equity, where the numbers are pretty much negative, so I don't need to really bother about going about with free cash flow to the equity. At least in this case I can say that free cash flow to equity cannot work out at all, unless probably if I want to really make it work, probably what I'll do is Instead of saying 10.5%, what about 20.5? If I take, what if 10.5%? Yes, looking better. So if I am taking the working capital investment just to be around 10.5% of the revenues instead of 20.5%, probably things are much better. So in this case also I can think of computing FCFF as well as FCFE, right? Net income plus depreciation plus interest into 1 minus T minus working capital investment minus the capital expenditure. This is what is giving me the free cash flow to the firm in each of these years, and similarly the free cash flow to the equity coming out as free cash flow to the firm minus I into 1 minus T. So this is what is coming out as the free cash flow to the equity. So here I am making an assumption of no new borrowing being done, right? Only the interest is changing at a different piece each of the years. That is what is the assumption I am going with. Now what we are saying is, as per the first analyst, he is making a conclusion that from the 6th year onwards there is going to be a constant 6% growth rate forever. So at least here I can find out the present value of all those FCFEs or FCFFs. So the present value of all those FCFFs, so that's where I call it as terminal value of FCFF, and similarly I will find out the terminal value of FCFE in both these cases. So the terminal value comes one period before, and I am saying this is FCFF1, the next period FCFF, divided by weighted average cost of capital. What is weighted average cost of capital? During the stable growth phase, we are saying it is 12.5%. So I will take it as 12.5% minus G. During the constant growth phase, it is 6%. So the present value is coming out to somewhere around 439.43 from the 6th year to infinite years. The present value is coming out to some 439.43. So now if I want to find out the value of the firm, now getting into the value of the firm using FCFF approach. So one is these 5 cash flows. So probably let me take these 5 cash flows using the NPV approach. NPV, for this 5 years my WACC is 15%. So I will say NPV at the rate of 15%, and I am saying these are my 5 cash flows. So these are the 5 cash flows. I am discounting them to the present value. So this is one part of the value of the firm. And also looking at the present value of the terminal value. So probably this terminal value I need to discount it by 1.15 to the power 5, because during this period the weighted average cost of capital is 15. So overall the value of the firm as per this is the summation of these two resulting in 291.83, and that is the million. So probably if I divide it by 2 million shares that are outstanding, according to me, okay, here 291.53 is the value of the firm. So from this I remove the value of debt. What is the debt here? 152.6 million is the value of debt. I remove the value of debt. This is what will be the value of equity, and I divide it by the number of shares, it gives me the value of equity per share. This should be the value of the share if at all I am going with FCFF kind of an approach. So the share price should be somewhere around 69.62 going with FCFF kind of an approach. Now when I am going with FCFE, these are the cash flows. Now when I go with FCFE kind of an approach, so the value of the firm using FCFE approach, I have to discount them with the required rate of return, but here I don't know the required rate of return. So what can I do? I have the weighted average cost of capital, which is 15%, weightage of debt into cost of debt post tax plus weightage of equity into cost of equity. This is what is the weighted average cost of capital. Now for that I actually require what is the current stock price, right? Because the current debt is 152, but I don't know what is the current equity part, right? So the current equity part I need to know to find out what is the cost of equity. Otherwise I need to know the cost of equity separately. So in this numerical I don't have the cost of equity separately, but I'm just giving you, once I know the cost of once I know the weightage of debt, we know the cost of debt, which is 10%, we know the tax rate. Once I know the proportion, I will be knowing the cost of equity also. From here I will find, weightage of equity also. The only variable that is left is cost of equity. So I can use the cost of equity and then use it as a part of my discounting. So probably let me assume for time being the current share price is $50. Right? The current share price is $50. Let me just increase. So current share price, I am taking it as $50. So based on this, probably I'll get the weightage of debt. So from here I get the weightage of debt as, the debt is 152.6 million forever, 152.6 million divided by 152.6 plus equity. Equity is now 100 million because we have $50 per share and 2 million such shares are there. So weightage of debt is something like this and weightage of equity is around 40%. So from here I can find out my cost of equity now, because weighted average cost of capital, which is 15%, is equal to weightage of debt, which is 60.4%, into cost of debt 10%, into multiplied by 1 minus t 65%, plus weightage of equity around 39.5% into cost of equity. So from here I can find out the cost of equity as 15%. Okay, so I'll find out the cost of equity here, which is 15% minus whatever is the weightage of debt multiplied by the debt, the interest rate 10%, multiplied by 1 minus tax rate 65%, and that divided by 39.5%, whatever is the weightage of equity. So cost of equity in this case almost 28%, right? So the same logic probably for the next period also I can use the cost of equity. So this is 27.97%. Instead of 15%, if I use 12.5% only, instead of 15%, if I use 12.5% only, then the cost of equity is somewhere around 21.65%. So these are the numbers probably are worth using for me, using the FCFE approach. Now in this case what I can do, I can find out the NPV at the rate of 27.97% discount for the first 5 years. Okay, this is what is my value of equity, and even the terminal value. Okay, now I did not compute the terminal value using the FCFE approach. The terminal value will come out as, okay, the next period FCFE divided by, here I require the required rate of return on equity minus the growth rate is 6%. So this is what is the value here. I take the present value as of this particular date, right? If I'm here, the problem is the FCFE in each of the years. I should not compute through this mechanism. Okay, let's see. So that is the terminal FCFE. Then I can discount even this FCFE to the present value. So I can say this particular value divided by 1 plus this to the power 5. So another this, and finally when I am adding up the value, the total value of the equity, using this mechanism is coming out to this plus this, and based on this the share price is coming out only to $25. Here the problem is, if the interest is increasing but the debt is not changing, actually the cost of debt is going up, right? Interest is increasing but the debt is not changing, which will make cost of debt actually going up. So the cost of equity cannot be constant for all these 5 years. So we have to rework at that layer, but just under the assumption, okay, if I don't change the interest at all, right, making an assumption that the interest rate is constant across, right, making an assumption that the interest rate is constant across, then the value of the firm is going to be this much. The free cash flows are going to be something like this and working out to be this number. Then whereas coming out to the value of the firm, value of the equity, and yeah, the other thing that comes out here is the weightages. Also they keep changing with debt and equity. Here in the first year the weightage is something like this, but now with the net income getting generated, the weightage of equity is actually going up, means weightage of debt is coming down. So all these things have to be taken into consideration to do the valuation. But of course, those things we can very well look at when we are practically doing the valuation by converting the free cash flow to the firm into free cash flow to the equity and all. But the easier way is you can look out for the free cash flow to the firm, find out the value, subtract the value of debt, arrive at the free cash flow to equity. That is much more easier to understand. Here also the same logic we can use. Let's say we are depending on the second analyst to find out what is the value as per his understanding, right? This one also, let me make it constant as the first analyst did, right? So if at all I want the terminal value here, I would be taking out at this point the terminal value, which is nothing but the FCFF here divided by the weighted average cost of capital, which is 12.5%, minus G, which is 5% in this case. So in this case, the terminal value is 323.05. And during this process, I can very well find out the total value of the firm, wherein for the first 8 years, I can discount it at the rate of 15%. All these cash flows for the first 8 years, I am going to discount them at 15%, giving me this much. And from the ninth year onwards, which is nothing but this discounted at 12.5%, so 1.125 to the power 8. So this is what is coming out. So when I am finding out the total value of the firm, it is going to be 214. Out of this, I subtract the value of debt, which is 152.6 million, to give me value of equity, and then divide this by the total number of shares, 2 million, saying that the value of equity per share in this case is around 31.06. So the best way to find out always is find out the value of the firm using the free cash flow to the firm approach, and from there remove the present value of the debt to arrive at the value of the equity divided by the total number of outstanding shares to finally come out with the total value per share. And just one more thing, now that we have used so many assumptions as a part of this particular model, it's always advised that this model has to be tested for sensitivity. Change each and every input variable, identify which all input variables are prone to change each and every input variable, and one at a time, and probably try to observe what is the kind of impact that it has on the value. So identify what is the percentage change that is getting impacted in terms of the value, and identify those key elements which are impacting quite drastically. So that will give you which are the critical variables for which more and more research needs to be done in terms of identifying their more or less exact values. And finally, coming to the interpretation part of it, right, in case of terminal value determination also, you can use the Gordon growth model as we have used in our earlier examples. And when it comes to interpretation, just like the dividend discounting model, when you see that the market price is greater than the model price, model determined value, I say that that particular security is overvalued. Otherwise, if the market price is much lesser than the model determined value, I say it is undervalued. If both of them are more or less the same, we can talk about it as fairly valued kind of a security. So this is how we use the free cash flow method for doing the valuation of the securities. The challenge is in terms of computing the free cash flow itself, right? More and more practice into the usage of the formula by going through the various elements of the balance sheet and the income statement gives a clarity in terms of using the free cash flow based analysis for the valuation of the firm. In case you have any further queries regarding the same, you can very well get back to me by giving me a call on the number that I have provided below, or you can even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.